Hi folks, Alex Klingelhoeffer here with Exencial Wealth Advisors. It's OKC CFA CFP on Twitter. I wanted to talk today a little bit about a question I've been getting asked recently from a few clients, and that's with regard to the global minimum tax rate. 15%, that's what the G7 is suggesting that large economies adopt to help even the playing field from country to country. What is the impact on the markets, on the global economy, and our investments in particular? Clients want to know. I'm happy to answer. Let's first take a look at economic history and see how taxes have been collected on business for really thousands of years. Most economic activity has been local or at least national. A butcher sells to a baker, sells to a toilet maker. And all of that economic activity is taxed at some level. Sometimes income taxes, sometimes it's profit taxes, etc. But the government uses those taxes to build schools, roads, firefighters, etc. In the modern economy, most economic growth, most economic activity is information. It's intellectual property. It can be easily moved from one place to another. The point of a global minimum tax is to disincentivize companies from moving highly valuable intellectual property and corporations from one domicile to another, right, from one country to another, just in the favor of having a lower tax rate. Let's give the U.S. as an example. 52 of the largest 100 companies in the world by market capitalization are here in the U.S. If the U.S. has a larger tax rate than, say, Ireland, a company can, in sort of a series of long steps, move their operations, move their intellectual operations from the U.S. to Ireland and pay a lower tax to Ireland, thereby avoiding U.S. taxation. This wasn't a problem 100 years ago, 50 years ago, even 30 years ago, because most economic activity was industrial. It was production-based. If you produce something in the U.S., you had to pay U.S. taxes. And if you produce something in Ireland, you paid Ireland's taxes. Now, with most property, most valuable property being intellectual, it's very easy to produce something in the U.S., move that intellectual property over to a lower taxation country, and then go ahead and be taxed at a lower rate, and the U.S. then loses out on all those taxes. What's the long-term effect of these sorts of policies? Well, it does lead to some sort of isolationism, right? We're seeing less companies move from domicile to domicile, chasing tax havens. It certainly decreases the billable hours from the lawyers that make that happen, but it really does create a more level economic playing field for the 21st century. And this is coming from someone who's about as free a market guy as you can get. I generally think government should stay out of the private sector. But on a go-forward basis, while it does decrease some profits for certain companies that are doing things like Dutch flips, moving not just jobs, moving intellectual property overseas, it does allow some of those companies to not be incentivized as much to move those highly profitable enterprises offshore, keep some of those tax rates here in the U.S., and keep some of those revenues going towards U.S. schools and houses and bridges and railways and that sorts of thing. So overall, it could be a good thing for the U.S. economy, maybe not such a boon to some of those tax havens, to Bermuda and Ireland, that sort of thing. Ultimately, if you have a more equitable global tax on profitability, you're going to see countries really not see it worth it to move tax domiciles just to pick up a couple of percentage points. It's not worth it at that point. So that's sort of how the global tax, minimum tax works, what we're looking for as far as economic activity. Ultimately, it's just going to really help tax revenues in countries where you have developed markets, you have higher social safety nets, that sort of thing. If you want some additional information throughout the week, feel free as always to follow me on Twitter. It's OKC CFA CFP. Until then, I'm out.